Hello, hello, hello. How's everybody doing? Happy War Monday. I am doing a YouTube today to discuss my new favorite idea. That is probably the sketchiest idea I've had since, I guess, Magnachip, but really all my stocks are sketch. The difference about this one, though, is it's a smaller company. So the market cap is south of 200 million, but it trades probably $4 to $5 million a day. I don't usually buy companies this small, almost never, and I also would not normally do a YouTube on one of them. In this case, I'm compelled to do it for a few different reasons. So, in no particular order, one, the market's depressing, and I want to distract myself. Two, if it goes up, I won't feel the urge to buy more. That's a lot of the reasons why I do YouTubes, even though most of my stocks are like billion-dollar companies and I don't even move them a nickel. Three, it's in a strategic process, and the higher it is always better for negotiations with third parties. And fourth, honestly, I just like the idea a lot. I also would love to hear feedback from anybody that knows the company well or about anything about this thesis. Though that being said, as usual, I'm as much of a software expert as I am a trucking expert, which is I know literally nothing about what this company does, except that it's a software company. I spent the last week reading it, researching it, reading about it, and acquiring my position. My position's about a 10% delta adjusted position. 7% is in common. 3% is in leap spreads that you can't buy today if you wanted to buy them. So I would focus on the common. Okay, my position. The idea is Domo, DOMO, and let's start from the most recent news first and why I got interested in it, and then I will walk you through the last few years of Domo. So a week ago Friday, so I don't know, 10 days ago, Domo put out a press release saying that they were launching strategic initiatives to maximize shareholder value. They haven't reported earnings yet. Their earnings are going to be next Tuesday. The stock didn't even go up. The stock went up, 3-4%, and is now at or below where it was before they did that press release. So that intrigued me. I then asked a friend about it, and my friend told me that the reason why the company trades such a low valuation, I'll get the valuation in a second, is that the CEO is a crazy person. And sure enough, I went back and looked at the last conference call, which is from November. They have a weird fiscal year where it ends in off months. So January is the end of the fiscal year. So they reported last in early December. Actually, I think it was like the first week of December. And the last paragraph, the last paragraph of that conference call says that the CEO's announced that he's going to rehab, and he is stepping down from his duties as CEO. He'll still remain CEO, but other people will take control of the company while he works on himself. It talks about him being a Mormon and how he's failed his family and yada, yada, yada. Everybody's entitled to make mistakes. Everybody's entitled to addiction and recovery, and I would wish him all the best. Unfortunately, that is not the whole story with the CEO. If you Google the history of him and the company, you'll find all sorts of hilarious things. There's a whole Reddit thread about him in Salt Lake and the company being toxic to work for. There's sexual assault claims made against him, made against other members of the executive team and executives there. None of it has been proven guilty in a court, but the company is controlled by him. He has super voting stock, and he owns about 10% of the shares outstanding. So nothing could happen without his approval. Fast forward to January, and the COO abruptly resigned and got a huge golden parachute of like $1.5 million and something like 300,000 RSUs that vest over the next 3 years. Finally, you have the CEO tweeting on February 1st. You could find his Twitter account on, I'll link it below. And he says that it was an exciting end of the quarter for the company, and they should meet or beat all of their forecasts. Oh, I should have said that in the strategic alternative press release, they said that they have reaffirmed select 2026 guidance, and that was a revenue range and a non-GAAP EPS range. Absent from that press release was what the free cash flow will be and what the billings will be. Now, if you go back through the historical press releases of this company, their formal guidance always is only revenue and non-GAAP EPS. They give billings guidance and they give free cash flow guidance on the conference calls. So it's unknown if we're supposed to interpret this as they're going to miss their billings number and miss their free cash flow number, and that's why that was not put in that press release. One sell-sider noted that that was absent. I'll also say that a sell-sider, a different one, caught up with management on February 1st or February 2nd, not the CEO because he's in rehab, and even though he tweeted that they beat the quarter. And they said that they feel, I think it was good about, the billings guide, which is hilarious since the quarter just ended. If you look at the stock chart, you'll see that the stock was on a tear through the summer and May. That was because they started growing billings for the first time in years. And then it all came up to an abrupt halt in December when they announced that they had flat billings growth year over year versus what the street was expecting was, I think, like a 2 or 3% growth. And they blamed that on large deals being pushed out by the quarter. The company is not traditionally inexpensive. Yes, it's been free cash flow positive every quarter, de minimis, but there's a huge stock-based compensation here, right? So the shares outstanding are like 42 million, and then you have to add dilution of many million more. I'm using 50 million shares to be ridiculously conservative, to also count for merger costs and all that other stuff. But it's probably more like 46 or 45 or 47 million actually fully diluted shares. There's 125 million of expensive debt outstanding that's due in 2028, and there's about 50 million of cash. But if you add other receivables and things like that, it's more like 50 million of net debt. But why don't we use 75 million in net debt to be conservative? So all in, if I'm using 50 million shares and I'm using a $3.70 stock price and I'm using 75 million of debt, I'm getting to about a $250 million enterprise value. It's like 260 million, okay? Domo does about 330 million a year in revenues. So it's trading at something like 0.8, 0.75 times sales for a business that should inflect this quarter to billings growth, okay? Now, the interesting thing about Domo is the company's been a complete dog for years, right? It had massive revenue declines, no profitability, and they turned it around in the last 2 years by moving from seat-based to consumption-based, whatever the fuck that means. I think seats are you pay based on the number of people you have. Consumption's based on how much you actually use the product. Again, I know nothing. I don't even know what they do. They analytics or something. What's interesting about that is it's a much more high-quality business as a consumption-based business versus a seat-based business. And in fact, if you look at their retention numbers, their net retention rates, they've all gone up over the last 8 quarters. Everything about the business has improved, yet the stock price has been destroyed. Stock price obviously has been destroyed this year with the SaaS apocalypse, coupled with their missing their Q3 billings number. Why do I think this is interesting? Okay, so first of all, the CEO said back in May of 2024 that, and I will quote you, hold on. Said, quote, May 2024, quote, I believe we'll either end up with several partnerships and revenue growth north of 20%, or I believe we'll sell to one of several potential strategic parties at a substantial premium that is multiples of where our stock is today. The stock was $8 then. Or one of many interested private equity shops. If we still believe the best way to optimize the long-term risk-adjusted stock price for shareholders is to sell the company, then that is absolutely what we will do, just like what I did last time with Omniture. The 12 to 24-month window expires between now and May 2026. If they were to sell for 3 to 4 times revenue, the stock would be $20 to $25. Now, the reason why I think this is so interesting is that there's no premium in this stock for a merger, right? And there's no premium in this stock for them to even hit their billings growth next week. So to me, it's like heads I win, tails I win, right? If they put up a good billings number next week, then we'll see that they weren't doing a strategic process just to try to get your attention away from a bad quarter. If they do put up a bad quarter, which is, let's say, a flat billings growth versus the expectations of 3 to 4%, it doesn't really change the strategic premium valuation that this should get in a sale. The CEO has also touted in the past, I read all the conference calls from the last 2 years, he says he's approached regularly by private equity and by strategics. Now, again, the caveat here is the guy is a bit nuts, okay? But he did sell his last company for $1.8 billion. He did go to rehab. And for all we know, he's a reformed person now. I don't really know what the point is of putting out a strategic process press release when he controls the company if he's not actually trying to get the stock up to have it be higher higher from a better place to be have negotiations to sell the company. 2 negatives, additionally. 1, he didn't say in the press release that they were approached by anybody. And then 2, most software companies do not do this, right? They contact Reuters and they say they've started a strategic process. They leak it. Start a strategic process, multiple suitors, whatever. I guess there's a third negative. Software is the worst it's ever been right now. And private credit is probably mostly closed. The idea of a private equity person buying them seems very low, given that while they're free cash flow positive, this is not a traditional private equity-like play with some sort of market leader that's growing rapidly that has a Rule of 40 kind of thing like this. Oh, by the way, they expect to end 2025 with 5% free cash flow margins and 5% billings growth. I mean, that's the idea. And then end 2026, with 10% billings growth and 10% non-GAAP margins. Of course, if they did that, the stock would go up, 3 to 4x. I don't think they will do that. I think that the numbers are going to come in light. Definitely those 2026 numbers. I just don't think it matters, right? It's trading at 0.75 times sales. So what could this sell for? If there's any value to strategic, they have a big partnership currently with they have several partnerships. I think CrowdStrike is one of them. And all these partners trade at multiples that are much higher than what they trade at. So it would be extremely accretive for any of them to take them out, fire half the staff, and you'll probably have 50%, EBITDA margins going forward once you combine the company. So I don't think that it's a big ask to think that they could get $8, $9, $10 a share for this versus the $3.75 it's trading at. Now, what's my downside? Let's say we fast forward 6 months, 9 months. It goes to negative billings growth. The billings growth is -1, -2%. Could the stock go to $2.50? It could. He's not incentivized to zero this, right? He owns 10% of the company, and he clearly has an ego on his shoulder where he wants this to be valued at the appropriate valuation. All of his employees own a ton of stock, right? They give out millions of shares a year. You also can't operate this company at this market cap given the share-based compensation. So to me, I think it's a multi-month process. I think the first thing is next week's earnings. You'll see his language that he has from the tweet on February 1st, February 2nd. I don't know how you can read that and think he's not going to hit his billings number, right? Closing the deals at the end of the quarter is all about billings. That's not about revenue. The revenue gets amortized over the course and the lifetime of the contract. So, and the fact that he says retention, the retention team made great progress. Again, I don't see how it's possible how you don't interpret this as they're going to put up a good number. That alone could get the stock back to $5 or $6, right? But I wouldn't sell it there because if the numbers are good, there is no purpose, no reason for him to do the preemptive strategic process. I think he's being honest about the strategic process, and I think the strategic process will result in a sale. think I covered pretty much everything with Domo. Um, that debt's there. It's there. It's a 2028 expiration. It's a pick. It's very expensive, and that's looming in the future as well. I would think that's easily refinanced, but maybe it isn't in this market. So again, he has at least 2 years to worry about that. I think he's just quite frankly pissed off at the stock valuation, and he's been valued at under 2 times sales for years, and I don't think he sees a credible path for the company to be valued at a real multiple, especially given what's happened with the broader SaaS market. This is why I'm focusing on a lot of these smaller cap names. The other one I own that I only have a 3 or 4% position in is PD. And PD, I think it's PagerDuty. I don't even know the name of the company. It's been written up in VIC multiple times. The most recent write-up was a few weeks ago. That's trading at 1 time sales and 4 times EBITDA. And there's a ton of stock-based compensation there too. But that's just cheap. And there's so many ways I think you could win there. So I'm trying to find a basket of these things. The Domo one is particularly interesting to me because of the peculiarity of the CEO being so disliked and also controlling the company so there can be no activist. I will say, to be clear, for someone that's so disliked, the stock went up to the high teens in the spring, in the fall when he started showing billings growth, which says to me that the product and the business is not bad. And I asked somebody about the quality of the business, and they said it's definitely not one of the shittier, SaaS software companies. They sell into regulated industries, and it would be pretty hard for those regulated industries to just give it up and go with, AI, for instance, coding their own back-end software. As far as the longer-term threat from AI, I don't think it's really that important if you think a strategic can roll them into their selling into their vertical or whatever the hell that they sell to the broader industry, to the broader marketplace. I've said enough. Anyway, disclaimers are real here, though. It's a smaller company. It's very sketchy. I don't know a shit thing about it. If I was you, I would read all the conference calls from the last 8 quarters. You can read them for free online. I've sent the link in the past. I'll put a link below where you could read them. And I would pray. All right, that's all. Let's hope my stocks, they're doing a little better since I started this YouTube. And let's hope there's some reason to come on here for other things in the next week or two, like Forward Air. Can we get a deal there? Anything in the next 3 weeks before my March options expire. Thank you very much in advance. All right, everybody, take care. I hope we get out of this war with not too many more casualties and an end soon, and we could stop having things ruin our weekend. All right, everybody, take care.